Gold will really take off when the Fed starts to cut rates before inflation is quashed. And, inflation is a long way from being over.
Hey, Adrian, how you doing?
I'm doing fine. Thank you, Andy. And thanks for having me back.
Yeah, you're very welcome. Thanks for coming back. Last time we'd spoken was last June, and a lot has gone on between, obviously, a lot of macro stuff between June and now. Some Fed easing, or not quite yet easing, but they certainly have come out dovish. And if my memory serves me correct, and I went back and talked about this with you, you mentioned that you didn't expect really for anything to happen or really move until the Fed came out dovish, and then possibly really move when they start cutting. So it looks like you were right. We did have a brief bounce in October with gold stocks, but gold has certainly run since October, come down a little bit. What are your thoughts on the macro now, where we're at with everything?
Yeah, no, thank you. I've always been a little bit more cautious or less optimistic than some of my friends. I think in markets generally, and in life generally, we always expect things that we know are going to happen sooner than they actually do. So if you look at the Fed, there's a couple of things. First of all, this was the most aggressive in terms of percentage, the most aggressive rate hiking cycle ever. It's more aggressive than Volcker. People forget that when Volcker came in, the Fed funds rate was already in double digits. So he doubled it, which is, incredible. I'm not taking anything away from Volcker, but we've gone from 0 lower bound to 5.5 in less than 2 years. That is astonishing. Or 1 year. That's astonishing. So that's the first thing. Yeah, I was a little bit surprised, to be honest, at the dovish tone in December. I mean, the Fed statement was dovish. The dot plot was, where the Fed members make their estimates of what they think things are going to be in the next year or two. That was very dovish. Big change from September. Big change on the dovish side. But then when Powell came out, he didn't push back at all, not even in a cursory manner. And he had plenty of opportunity to. He didn't push back at all from the dovish commentary, which says to me that it's quite clear that the Fed internally, they've already changed their mind. That's the important thing. Now, they're meeting this month. I don't expect a rate cut this month. If anything, we might get commentary suggesting we're not going to cut too quickly and too soon, and we're worried about inflation and so on. Unfortunately, the reports, inflation, CPI inflation, and the jobs numbers have gone the wrong way for the Fed to be. They both of those higher job numbers and higher inflation would tend to make the Fed want to be a little more restrictive. I don't think we're going to get a rate hike. But come March, which is the second meeting, I think there's a very, very good chance, better than 50-50, that the Fed will do their first rate cut. And once they do the first rate cut, I suspect, that's a mind shift. You don't raise rates, cut them a little bit, then raise them again. And so I think we're going to get a series of rate cuts in the next, let's say, 18 months. Once they start cutting rates, that's going to be extremely bullish for gold. And I don't know if I said it in the interview with you. I remember talking about, the lags and so on. But with regard to gold, I've said, for the last year, when people have been saying, why isn't gold moving more? Why isn't gold moving more? Gold will really take off when the Fed starts to cut rates before inflation is quashed. And, inflation is a long way from being over. And let's not forget, yes, the numbers have come down a lot. But let's not forget, even if you look at the Fed's own preferred measure of inflation, which is core CPE, which assumes we don't eat and we don't eat our homes. But even looking at their preferred measure, core CPE, and looking at their own target of 2%, we're still 60% above their target. So we haven't killed inflation yet by any means. That was a long answer. I'm sorry.
Well, yeah, there's a lot to unpack there. If you would bear with me, a lot to unpack there. Really, what I would say to you, or I'd ask of you then, is like, it looks like that in all of that, a dovish Fed, it looks like gold's been building a pretty strong base over $2,000. We had a pretty good bounce in the stocks, which I thought was interesting, because that's typically what happens is the stocks lead, and it hasn't happened for a while, if you would.
Yeah.
So I thought that was interesting. And I would just, where my comment would be, or my question would be, where are we at now then, assuming that the Fed, they're certainly dovish, but assuming they do what you say and quite possibly will be cutting in the springtime or the summer, where are we in that investment cycle, if you would?
Yeah, no, that's an excellent question. You're absolutely right. If you look back, let's just say a year, let's look from the beginning of last year, gold has done well. And a tangent, I think gold investors always expect gold to do more. They're never happy. But
Very true. Very true.
And I'm a gold bug, so I put myself in that camp. But we always expect gold to do more. Gold's done well last year. So gold did well, but well outperformed the gold stocks. Gold also outperformed silver, and silver outperformed the gold stocks. And then if you look at the juniors, the junior gold stocks and the junior silver stocks, they're worst of all. That's over the 12-month period. And we can talk about why that is in a second. And if you just look, as you said, from October, November, I'm looking at November, the bottom, gold stocks started to outperform gold. Silver started to outperform gold. Silver stocks started to outperform silver. So all of those things are things that you expect in a bull market. But I think the market was ahead of itself. I think the market was, overly optimistic on when the Fed would start cutting and by how much it would start cutting. And we're talking about beginning of November. So we're already 2 months past that. And we've seen a bit of a retracement. Well, we've seen quite a bit of a retracement, particularly in silver and stocks since then. Where we are at the moment, I would be extremely hesitant about selling anything. I mean, unless you're doing it for tax losses, selling one and buying another or something. But I'd be very reluctant about selling. But I think we may have to wait a couple of months before gold takes off. There's always a risk in the next month or 2 or 3, but we get another high CPI number. We get another high jobs number. Again, another tangent. I don't want your listeners to think that I am, that I drink the Kool-Aid. I mean, those jobs numbers were good. But let's not forget, at the same time we had a beat on the December jobs, they reduced the number of jobs from the previous 2 months. So if you look at the 3 months, it really wasn't that good. And there's a lot more we could say about the jobs market. So I don't think the jobs market is as strong as it would appear. But nonetheless, you have a low unemployment and you have high jobs numbers, you have higher inflation. We could see another 1 or 2 reports like that. We could see some Fed spokesmen come out with hawkish statements, and that might put a damper on the market. So,
Which they do all the time.
And the market is interesting. Over the last 12 months, you probably noticed this. It's really interesting. When that happens, the market is reacting less and less and less as time goes on. So they're not really listening to all that noise anymore. But what the Fed does and what Powell himself says is still important for the market. So that's a long-winded way of saying I think we may have to wait another 2 or 3 months. And March isn't a cut in March isn't baked in the cake.
Right.
But there's another consideration here, of course, which is the election. There's an election coming up. The Fed historically, whatever Jerome Powell says, the Fed historically has not liked to appear to be political. So they've raised rates a lot. It would be natural for them, especially if the economy slows at all, it would be quite natural for them to just pull back a little bit. With the election in November, they don't have too much time to wait. So March, probably, May, I would say definitely will get a rate cut. So this is a time for investors to really, if you're underweight gold and gold stocks, to really start getting to your full weighting.
Got it.
Understanding you may have to wait a month or two.
Yeah. And that's a great lesson, a great point for all of us, not to get the immediate, who are looking for immediate gratification, if you would. Again, a lot to unpack there, but let me go back to the Fed targeting inflation, because I don't know for how long it's been, but I mean, since I can remember, they wanted to target a 2% inflation. It doesn't seem like that's achievable, is number one. And want you to comment about that. And then number two is, let's talk about, okay, accumulate. And how would you start accumulating? What would you start with? And go from, like, some of the bigger players to some of the smaller ones, or whatever. How would you start building now?
Well, the first thing to mention, I mean, it's really funny. This 2% is a totally arbitrary number. And I don't know if you know or most of your listeners know, but, it came years ago when the chairman of the Reserve Bank of New Zealand said, we want to get inflation down, but it doesn't have to be zero. And someone asked him the question at a press conference, well, what number would you be happy with? I don't know, 2%. And then suddenly, every central bank around the world has adopted, including ECB, they've adopted this 2%. Well, that's not no inflation. Stable money, stable prices is zero. And the optimum, of course, is a mild deflation where prices come down over time and your money becomes more valuable. But that's a totally different thing. But the 2% is totally arbitrary. And but now it's become almost a religion. I don't think we're going to get to the 2%, frankly. I don't think we're going to get there, even temporarily. I think I wasn't surprised that inflation was moving up now because of the base effect from last year, and also in the US, and frankly in Europe too. In Europe, you had very high numbers a year ago. Remember when Germany was at, I think, 9%? Or was it even higher than that? But you had very high numbers, so it's not surprising that the numbers this year are lower. The year-on-year comparisons are lower. So I don't think we're going to get to 2%. And I think come the end of the second quarter, beginning of the second half, we're going to see inflation start moving back up to the 4 to 5% range. An awful lot depends on oil, of course, because oil is not just heating and gasoline and transportation, but it's every good that's in the store. Their price is determined to some extent by the price of oil. And the price of oil, as we all know, is determined by many, many factors other than monetary factors. It's been a surprise to me, I'll be honest, a big surprise to me that the oil price is not higher with what's happening right now in the Middle East. U.S. warships being attacked with Israel, Iran sort of pushing that on. It's really surprised, and a lot of ships not wanting to go through the Straits of Hormuz. It's been really surprising to me that the oil price isn't higher. Now, when something like that happens, When a market doesn't react the way you expect, you really need to sit down and start saying, why is this happening? Because there's something I'm missing. I don't think it's because OPEC is, flooding the market with oil. So is it that demand is really not as strong as we think it is? I don't have an answer. I'm just saying that the oil price is a bit of a surprise to me, and where the oil price goes is a big factor in where prices in the stores go. But moving on to,
Well, yeah, let me interrupt you. That is a point very well taken, because I am shocked that oil's not higher, even marginally higher. In fact, with all the news, it seems it's settled around a $70 floor, and I watched oil really, really closely. So yeah, that's very confusing to me. But yes,
do you have any explanation for why it's weak?
You know, the only thing I can think of, well, I'll give you three things. You have deflationary pressure, perhaps domestically here in the US, but also specifically from China. They're not growing at the rate everybody thought they are or should be. So I would chalk that up as number one. Number two is you have an election year coming up, which oil is very, very political. And I don't know how, and I'm not saying that there is either, but how you would manipulate oil. I mean, you can do the Strategic Petroleum Reserve, which they did for an election, but I can't tell you specifically how that would be manipulated. Third, I was reading a report. Fundamentally, oil should even be higher. But because of all the computerized trading, and this could be with the gold market or the copper market, if you would. It's a bunch of bots just pounding something into the ground or pushing it way up just because of some computerized algorithm. I do think that has something to do with that, but ultimately fundamentals, and I'm not making a bullish case for oil here, even though I am a bull, but fundamentals will take over, whether that's up or down. So that would be my answer to you.
Well, no, I think that's interesting. And I think they're all valid points. China in particular, the demand from China's down because China is 50% of global oil. They only have to be down marginally for that to be significant to the market.
Right.
But let me get to your question. There was an awful lot you said there we could talk about all night.
That's a whole nother topic, right?
If I had a glass of wine with me, a good Bordeaux. But how I would start, of course, nobody, I'm sure, is starting with a tabula rasa. Everybody has something in their portfolio. But let's just make the assumption that someone just inherited some money, and now they're putting it to work. I think you start and emphasize the major companies as both the major miners and the major royalty companies, because they will be the first to move when gold moves. And more importantly, or as importantly, they will be the most certain to move when gold moves. I can just look arbitrarily at, let's say, 4 of the largest mining companies and royalty companies: Agnico, Barrick, Franco, and Royal Gold. And let's say Wheaton. Those 5, if gold goes to 3,000, those 5 will be up. There's no question about it. Yeah. But if I buy, and I'm not going to name the real companies, but if I buy Ajax, Consolidated, and International Moose Pasture, they may or may not be up. On balance, so I would start with the senior miners, the good quality senior miners, and the big royalty companies, which is basically Franco, Wheaton, and Royal Gold. My favorite of the miners, if anyone's interested, would be Agnico and Barrick. Then I would look at some of the junior and intermediate producers and the advanced developmental companies. I mean, a company like B2 Gold, for example, is a very good buy here. I think it's a very solid company. It's traded down after they bought Goose Bay. Gosh, I've got the name of the company now. Company's gone. It's off the screen, so I've forgotten. But Goose Bay was the project. Sabina, up in Yukon, and they're building the mine. So as often happens, stocks come down when they're in that phase of building, because that's spending money. It's when things can go wrong. Rarely do you have pleasant surprises when you're building a mine, even if it's on time and on budget. It's
Right.
not a pleasant surprise. It's what you expected. So anyway, but the company's very solid, great balance sheet. They pay a dividend. Anyway, I don't want to go on too much about that. And it's a well-diversified company. So companies like Beat, to me would be that next phase. And then I would look at this point, I would start to accumulate some of the, what I call some of the really solid junior and exploration companies, but focusing on those that either have cash, good balance sheet, or have cash flow, and there are a few, or at the minimum have access to capital so that raising money is not going to be an issue. Because the thing you want to avoid, I think, at this point in the cycle is buying, however good the project might be, buying companies, even if they have good projects, that have to raise more money just to keep going, because that's dilution, and the market punishes you for it in this point of the cycle. So I would look for companies that either have very strong balance sheets or have access to capital. So a good exploration company I like that has a good balance sheet would be Midland Exploration. Now, the problem with a company like Midland is an exploration company. They're doing all the right things. They've got all the right partners. They've got, 7 active joint ventures going on at the moment. Their partners include BHP, Rio Tinto, Cisco, etc., Barrick, etc. But they still have to make a discovery to be successful. But at least with the good partners, with multiple projects, and with a strong balance sheet, so they don't have to raise more money. You're increasing your odds. Another one would be a company like OGN, which has a strong balance sheet, but it also actually has cash flow from a royalty they own. And so all of the exploration they're doing is covered by the cash flow that they're getting in. There aren't many, but there are a couple of exploration companies with free cash flow, which, is a little bit of an anomaly. Mondoro is another one. Mondoro, I don't know if you know that. That's a company with projects both in Arizona, but most of them in the Balkans, mostly in Serbia. And they're partnered with RTZ, Kinross. So they have good partners as well, but they have positive cash flow coming in. And so they don't have to go out and raise money. And that's the key to me with exploration companies.
Yeah, it sounds to me like when you're evaluating a company, when you want to write them a check or buy them, that you're looking at positive cash flow. That's probably it sounds to me, and please correct me if I'm wrong, that's probably your top criteria. And then it's like, who are they doing this with? Who are they partnering with? And then what would you look for? Would you look for jurisdiction? Would you look for what management they have? Talk to me about that.
Yeah. Well, there's a difference between, it's the same factors, but the emphasis is different between a major mining company and a junior exploration company. With a major mining company, you basically have to go where the mines are. And it's much more difficult to get major mining companies and restrict yourself to good jurisdictions. Now, a company like Agnico that I mentioned earlier, that has an extremely good geopolitical risk profile. Their mines are in Australia, Canada, 2 parts of Canada, Nunavut and Ontario, Finland and Mexico. And
Great jurisdictions.
Even Mexico, with everything that's going on there now, in the context of the world and in the context of mining, is still one of the better jurisdictions. So Agnico, which has made a point of eschewing difficult jurisdictions, has a very high risk profile. Now you look at my second favorite, Barrick. Barrick, nobody could accuse them of restricting themselves to good jurisdictions. They're in Tanzania, in the Congo, in Papua New Guinea, in Pakistan, and now they're in Saudi Arabia. I guess you could say that, well, two things. You could say, I'm not being flippant here. You could say that they're diversifying their geopolitical risk. So they have geopolitical risk, no question, but it's diversified. And secondly, I think you have to give Mark Bristow, the CEO, credit. He was the former CEO he built Randgold, which was focused on Africa. But he has a long history of being able to work with let's call them difficult jurisdictions. And since he's taken over, he's fixed the problem Barrick had at Tanzania, where the Tanzanian government had actually was threatening to nationalize the mines. Congo, where the mines were still operating, but they weren't allowed to take money out of the country. So what's the point? He fixed that. Papua New Guinea, he's fixed that. And now he's fixed when I say fix, he's fixing the agreement in Pakistan, because they did have a case before, an arbitration case, but he pulled that and made an arrangement there. So he's been very, very good at being able to work in these jurisdictions. Not everybody can do that. Now, so for the seniors, I think what's important is the track record, the mines, and the pipeline of mines that they have. You want to make sure that the company has a pipeline to keep going. If you look at an exploration company, then I think management becomes my number one criterion, to be honest, even above balance sheet and cash flow, because, bad management can squander cash flow and squander a balance sheet. So I put management number one, followed very soon after that by either cash flow or a balance sheet, either one. And I don't want to see an exploration company with just one project in a risky jurisdiction. Now, I want to see some expertise. I want to see some focus. So they might be, I mentioned Midland, they're focused in Quebec. They know Quebec like the back of their hand. If Midland were to come out and say, oh, we bought this project in Namibia, it's really nice, it's really cheap, I'd really wonder what was going on.
Right.
Now, I mentioned Namibia. I'm not against risky countries, but it's a matter of, is the expertise there? Like B2 Gold has a mine in Namibia, and Namibia is not that risky in the context of the world, just to clarify. But I own a company, small company,
No problem.
Exploration. Well, they're in Eritrea. I don't think anyone would say Eritrea was one of the top safest jurisdictions in the world, but the people who are there have long experience. I'm talking 20 years experience and success working in that jurisdiction, and have sold two separate companies. So I feel comfortable with those people working in that place, if that makes sense.
No, it makes a lot of sense. And in fact, that's somewhat of a common theme, is people will go where there's a less than desirable jurisdiction, as long as they have confidence in management or leadership to navigate that. And then number two is just if they're going to be compensated for the risk reward.
Of course. Of course. If Alpha's metrics, valuation metrics were the same as, and I'll just mention Midland because I've mentioned it before, in Quebec, there would be no question I'm going to go to Midland and not to Alpha in Eritrea. But if you're buying it cheap enough, which you are, in my view, then I'm perfectly happy doing it.
Right. Lastly, if you just comment, we talked about the capital markets. How is that for a miner now? If you could comment about that, What is the access of money? How do you view that now with even with interest rates as high as they are? How are these guys? Are they having access to funds?
Yeah, for juniors, it's been extremely difficult, and it continues to be difficult. Several, I won't name names, but several companies have come to me and said, "Hey, they take you if you're a shareholder, they'll take you over the wall, so you can't buy or sell shares." Well, but how would you feel if we did this? You're one of our shareholders. How would you feel if we raised money? I said, well, I'd be in, what's it for and everything else. Okay. So they want to raise $5 million. Okay. Put us down for $1 million. 3 months later, hey, how's that raise coming? Well, we're at 2.2. Okay.
Wow.
That sort of thing. And then a month after that, they have to pull it and say, well, we'll come back later when the market's better. So that's happened a lot with junior exploration companies, particularly with new companies. So that's very, very difficult to raise money now. Companies that say, another real example, company, good management, had some success, got a second plan, for the next year, want to raise 15 to 20 million. Came back and said, well, it doesn't look like we're going to be able to raise that. We've adjusted our plans. If we get 5 million, we can do plan B. So it's very difficult. Now, for companies that are developing mines, equity is difficult, is expensive right now. Bank loans, if you're in the US banks are not lending for mining projects. Some of the Canadian banks are still lending for mining projects, but sometimes the terms are a little onerous. Things like international development banks and things, they will lend, but you have to be in the right project for that, in the right area for that. You can always get flow-through funds in Canada. Do you know flow-through funds?
No, I'm not familiar.
Flow-through is where the investor gets an immediate tax write-off of the money he puts in. So they're very tax beneficial. The funds have to be invested in exploration in Canada. So it can't go to G&A or anything else. So companies will frequently say, we're going to raise $3 million, $2 million flow through, $1 million non-flow through. And the flow through is frequently done at a premium to market because the investor gets a write-off.
Sure.
You can normally raise money for that, but we're talking small amounts. We're talking 1 million, 2 million, 3 million. We're not talking a development company that want to raise $100 million. So that's that. So where does the money come from? More and more streams have become, are now a standard part of a financing package. So if a company wants to build a mine and they want develop a mine and they want $150 million, a stream is going to be part, with few exceptions. There's still some people who just don't want a stream on their asset, but a stream is going to be part of the financing package. And so if you get a stream from one of the major companies, that's sort of an endorsement on your project, makes it easier to get the equity financing, but it's still difficult. Now, if I may, over time, over the last couple, 2 or 3 decades, things change. There's times when equity is easy to raise and prices are high. There's times when it's easy to raise debt, even if it's not cheap, it's still easy to raise. So these things come and go, but right now, equity is expensive and debt is not the easiest.
I guess I'd comment, it seems like we're going to have another flush out possibly of the weaker players. And then it's a good opportunity for stronger companies, but also as an investor to identify those stronger companies because they'll be the only ones in the sandbox, if you would. So.
Oh, sure.
Well, Adrian, I don't want to take up any more of your time. I really enjoyed our last conversation and I enjoyed this one more. So thank you.
Oh, well, thank you for that.
Yeah. So if you would let us know, give us a blurb of where people can find you. And I know that you manage this for a lot of wealthy investors. How do they get started with you if they're interested?
Yeah. And they're not only wealthy. We do gold accounts actually with pretty low minimums. We're not, the gold accounts we do. So people can get to us at Adrian Day Asset Management. Yeah, adriandayassetmanagement.com.
Excellent. Again, I want to thank you so much for your time. I'd love to have you on again, maybe in the next quarter or maybe second quarter sometime. And
Thank you.
yeah.
No,
All
I
right.
enjoyed the interviews with you. Thank you.
Have a great day.
Okay. Thank you.